Hello and welcome to the Maine Community Foundation's Investment Program Update webinar. We appreciate all the donors and fund holders that have taken the time to join us here today. And we hope that many others will get an opportunity to listen to a recording of the webinar that will be posted to our website shortly after the program. So I am Leanna Kingsbury. I'm going to forward to our presenter list today. I'm director of our nonprofit agency funds, and I'll be joined today by Deborah Elwood, our president and CEO, as well as Brendan Ray, vice president of investments. During the webinar, if you do have any questions, we encourage you to use the Q&A feature. I will be keeping an eye on those and make sure that any of your questions get passed along to Brendan. You can always email me if that's more convenient. My email address is lkingsbury@mainecf.org, and I'll keep an eye on email as well. And then, of course, after the webinar, if you have questions, Brendan and I are always available, so please feel free to reach out anytime. I'm going to stop sharing that slideshow just for a minute and mention that I think, as some of you may recall, we have offered a similar program on an annual basis, and we do plan to continue to do so with another investment update in February of 2023. That webinar will not only include an overview and a review of the portfolio and how things went in 2022, but we plan to also share with you some of the exciting plans that the Community Foundation has for 2023 and going forward. So stay tuned for more information on that webinar. Dates and details will be provided with your year-end fund statements that you'll get in January. But for today, it's all going to be about the portfolio. As we know, it's been a bit of a challenging year. Brendan and the investment committee have worked hard to manage that volatility, and we thought that this would be a good chance just to do a quick check-in, give an update of how things have gone so far, and of course, give you an opportunity to ask any questions that you might have. So we're going to turn things over to Brendan, and then at the end of the program, we're going to set aside about 10 minutes for Deborah to share some of her thoughts and some of her observations and things that she expects to see going forward. So Brendan, I will turn it over to you.
Thank you, Leanna. Good afternoon. Good afternoon, everyone, and thank you very much for making some time for this update on the investment program here, and specifically on the portfolio performance and what's going on. As Leanna mentioned, it's been a challenging year. And thank you especially for joining on what feels like a positively tropical day outside. It's like 65 degrees here in Ellsworth, so a beautiful day to be outside. So thank you for gluing yourself to your screen for just a little bit of time for these remarks. Leanna, can you pull the slideshow up again now, and we'll get started and start talking. So the first thing this first slide is just a reminder, and for those of you who are not as familiar with what we're doing in the investment program here, some high-level philosophical statements, I suppose, drawn from our investment policy statement about our objective. We're aiming to return at least 5% net of inflation. Obviously, this year we're not doing that. Some years we're going to do much better than that, and other years we're not. And when you smooth it out over time, that's where we're hoping to end up. I wanted to also talk for just a second about risk. This is a particularly important concept for everyone to understand. There may be more kinds of risk, but there's two kinds of risk that we spend most of our time focused on. One is the fluctuations in the value of our investments. This is volatility, and this is very normal, and that's what we're experiencing now, a lot of volatility. It's all volatility. It always feels more painful when it's volatility to the downside, and that's what we're experiencing, and it's very normal. And the other kind of risk is the permanent loss of capital. That's when whatever you have goes to zero, and you lose it forever, and we are not in that business, and we work very hard to make sure that we never will be. One way that we try to manage volatility or control those fluctuations is with diversification. So our portfolio is is globally diversified and in multiple different asset classes. And then one way that we try to make sure we never permanently lose capital is through vigorous due diligence of the underlying investment managers that are managing our capital. And this last statement is just what I always want to remind everyone, that we are and we will always be a vigilant long-term investor. We are focused on safeguarding your assets and growing the ones that you've entrusted to us. So I'll come back to that long-term orientation here soon, but just a quick reminder. So let's dive into performance. Here's how we're doing so far and over the long haul. As you can see, 2022. Now this is as of September 30th. We had a good October. I just don't have good enough numbers to share with you October numbers just yet, but it was positive. October was a good month. So these numbers are all a little bit better than they look. This is as of the end of September. 2022, we're down 16, a little more than negative 16% net. You can see the 3, 5, 7, and 10-year, and then since inception numbers, all in the 5-year number around 6.1, otherwise with a 7 handle on those numbers going forward. We've also included in the orange bar, this is a collection of endowments and foundations that are roughly our peers, from $250 million of assets up to $1 billion. We're at about 600 million and change right now. So we're kind of in the mid spot there. That's what that orange bar represents. The gray bar is our benchmark, and the blue, the light blue bar is a 60-40 ACWI Bloomberg Ag Bond Index, a very sort of typical asset allocation. And then green is CPI, and obviously going up. It's the only number that's gone up this year is inflation. So you can see on a relative basis, we're holding up quite well, and we always have done very well against these different measurements. It's not very comforting. I know you can't eat negative relative performance, but at least shows that we're still hitting the ball relative to our peers. Next slide, Leanna, please. Thank you. And this is something that came up very recently, so I wanted to include it. This is so the other metrics on that previous slide were measuring us against endowments and foundations, broadly speaking. This is just community foundations. The data are as of the end of June, so not quite as live or real time as maybe we would like. But this comes from the Crucial Fog Survey as of 6:30. All participants there, you can see the numbers, 129. Only 20 community foundations over $500 million. And then I also included a little bit smaller group of community foundations from 250 up to 500 million. And there's 13 of those. We are the navy blue bar here, and so you can see where we are. And then our peers of 500 million and over doing substantially worse than us. And then ditto for the 250 to 499. So again, just wanted to give you a feel for where we are with our peers. Next slide, Leanna. Thank you. This is a quick overview of our asset allocation. This is how we divvy up the portfolio into the different asset buckets. Our target allocation is on the right-hand side. This is our ideal of where we're always aiming at. And then the actual allocation is what's on the left, again, as of September 30th. And you can see those things change. Our listed global equity percentage, for example, is roughly 37% at the end of September. Our target is 50. Obviously, that part of the portfolio has lost value in the last 9 months, and so that's pulled the percentages down. So these percentages move around a little bit as the portfolio moves around. Marketable alternatives is a fancy name for hedge funds, or maybe hedge funds is a fancy name for marketable alternatives, but those are different kinds of not necessarily long only public equity sorts of investments. And the gray slice of pie there represents private equity and venture capital. We're a little heavy with private equity and venture capital, and that is in part because of our public equity has gone down. We're a little heavy though also because in the last 10 years, that has been a really big driver of the growth of the portfolio, which both of those private equity and VC have done very, very well. So they put on some weight. They got a little bigger and grew up over that period of time. and cash and fixed income remained relatively fixed at 15%. Mostly, that's largely cash as opposed to bonds. I'll come back to that later, which has been an important decision. So that's our target versus where we are actually. Next slide, please, Leanna. So here's the ugly news about 2022. This slide. What this slide shows is the market returns for 2022, including the top part is just the third quarter of 2022. The bottom part is the entire year. And this is a collection of different indices. So everything from the S&P 500 to cash to various bond indexes. You can see on the left-hand side, that's 90, those are the 90-day T-bills, basically cash. And it moves from there over to the right, from treasuries to tips, a high yield index. The Bloomberg US Ag is that sort of pine green. It's the fifth one from the left, down 14.6% for the year. And then you begin getting into various equity indices. The Dow Jones Industrial Average is that navy blue. The S&P is next to it in rust, and it goes on from there. The far right is the NASDAQ, down 32% for the year. Perhaps most familiar to us as a very tech-heavy index, and that's really what's been the race for the bottom. Has been a lot of the technology stocks and sort of everything in between. You know, you don't need a PhD to notice that all these bars are going the wrong way. They're going down, not up. It's been a very difficult year. Both the bond market and the equity markets have both been returning negative. So that gives you a little feel for what's been going on. Everything has been going down. Next slide, please, Leanna. Now, one of the things that is interesting about that previous slide is that both the bond market and the equity markets have been negative. That does not happen very often. So I guess that's another way of saying that this is a somewhat extraordinary year in the way that these asset classes are performing. Since 1926, 10% of the total quarters have been quarters where both the equities and bonds were negative. So that doesn't happen. So when both of those things are negative, not very common. 10% of the total in basically almost a century. The real stunning thing is that in almost a century, there have only been 2 calendar years when equities and bonds were both negative. One of them was right at the beginning of the Great Depression. The other one was 1969. 2018 was awfully close, but it doesn't qualify. So if we continue where we are now, we will be the third calendar year in almost 100 years where both the equity market and the bond market were negative. So just to give you a little feel for how unusual, in a particularly painful way, how unusual this year has been. This is just a different, I'm very much a word person, but pictures are wonderful as well. This is a slightly different view so that you can see how unusual this year is. It only goes back to 1977. The blue spikes and daggers and things going up and down, the blue line is the S&P 500. You can see it's largely been up. You can see in 2008 it went down dramatically, but most of the time the S&P has been pretty positive. The black squiggly line that's interposed or superimposed onto the blue, that's the Barclays Ag, the Bloomberg US bond aggregate. That's a bond index. And you can see that by and large that index has been positive. And you'll also notice that in the few occasions where it's negative, the equity markets have been positive. And when the equity markets are negative, the bond market has tended to be positive. Well, on the far right, you see exactly what's happening this year, where the bond market and the equity market are both negative. So just a way to graphically represent what an unusual year this has been so far. So that's the bad news about performance and what's been going on with the portfolio and what's been going on in the markets and how unusual it is. So what's the near-term outlook? What do we think is going to happen in the near term? Well, the first thing is we're in a bear market. And The historical average length of a bear market is 19 months. That's once you go from a peak to a trough of more than 20%. That's the official definition of a bear market. So if you go back to January, on the peak back in January of this year, we're 9 months in. Again, historical average length around 19 months. We're 9 months into a bear market. So candidly, expecting more volatility and possible downward pressure from here. Is there some near-term relief? There might be in the form of the midterm elections. I'm going to show you a slide in a minute that shows how in the 12 months following midterm elections since the 1940s, the S&P 500 has always been positive. We'll see what the last point is. Will there be a recession? I'm guessing probably all familiar from the news and the data that you see and all the conversation. And when you go to the grocery store, the conversations about inflation. Will there be a recession? Our thought is probably. The real question, though, is when will the recession, when will that happen and how severe will it be? There's a lot of conflicting, if you will. The data are not unanimous in answering any of these questions. So our view is it's likely, and but there could be a little bit of near-term relief here with midterm elections. So Leanna, if you go to the next slide, these two slides get very busy, but here's the data that support or that I'm leaning on for those previous high-level comments. On the left-hand side is a chart that shows bull and bear markets going back to 1928. The right-hand side of that are the bear markets, all those negative numbers in red. This includes the Great Depression. It includes the Great Financial Crisis of 07, 08. It includes the tech collapse in 2000, et cetera, et cetera. And you can see that those bear market returns have averaged around 36%, and they've typically lasted about 19 months. So in the middle of June, that's when the S&P 500 correction had officially, if you will, gone into a bear market when the index was down 21% from its record high in early January. As of the 30th, the index had been down about 24%. We recovered actually substantially last month in October, but it's still negative for the year. And the right-hand side, what's interesting about the right-hand side is it shows the annualized performance of large cap US equities since 1926. But you had to be in the whole time in order to experience that. In other words, you had to experience the decline and the trough before coming out. If for whatever reason you decided to exit or miss some of that time, you can see how the returns get dramatically worse from that 10%. So this is the data on the bear market data. Anna, can you there? Thank you. So this is the countervailing data, which is sort of interesting in the near term. This shows the average monthly performing during midterm election years. It's true that you can collect statistics about just about everything, and you can see that the S&P 500 has done well regardless of which party has won or lost a midterm election. October is usually the best performing month in a midterm election year. Witness last month was a pretty nice return. And the average fourth quarter total return is 7.7%. The caution I would put in here, and you can see on the right-hand side the bar charts of those midterm election, the 12 months following midterm election years, you can see what the performance of the S&P 500 has done since then. And the question mark on the right-hand side is 2022. And the thing that the cautionary note here or tail here is that it's really unclear what either a recession or the fear, probably equally important, the fear of a recession might do to this historical pattern. Really unknown. So there we have both the data for a bear market and the data for midterm elections, and what is actually going to happen going forward. Obviously, I don't know, and we don't know, but that's what we're thinking. Next slide, please, Leanna. I guess that's the near-term outlook, and at one level, that's both important and and interesting and good for us to talk about and be paying attention to. And I worry about these things every day. But the real crucial thing for us to remember is the long-term outlook. And all I did here, this is a very simple illustration of this. This is the S&P 500 from 1902 to 2022. And the reason why I wanted to show this to you is you can see it moves from the lower left to the upper right over time. This includes the Great Depression down there, sort of in the bottom to the left. You can see that big dive off the cliff there. That's the Great Depression. If you follow it forward, you can see all the little jagged edges. You can go up to the tech crash around 2000 and 2002, the Great Financial Crisis in 07. You can see the dip, and you can see up there on the very blip on the right-hand side, you can see we have a little bit of a beginner's ski slope, if you will, just kind of turning over and running downhill there. And again, the reason I wanted to put this up is to say that when we focus on the long-term outlook, the long-term compounded growth rate of our portfolios, this is where we need to be thinking. So it's not, of course, it's important to be thinking about the recession and bear markets and midterm election cycles, et cetera, but really the most crucial thing is to be thinking about the long-term compounded annual growth rate of portfolios. It happens that the S&P 500 has returned since that time about 10.6% per year. That's what it's compounded for more than a century. And through all of those ups and downs and like the Great Financial Crisis, the S&P is down 37%, et cetera, et cetera. So it's just a way, I hope, to focus you or have you continue thinking, as we are continued thinking, about the long-term nature of what it is that we're up to here. So that leads me to my conclusion, which is nothing particularly revolutionary. This portfolio is an all-weather portfolio. It is global. It is diversified. It is built to withstand tough periods like we're experiencing now, and it's built to compound very well when we're in more expansion type moments. We have hedge funds, cash, and our low bond exposure have been our anchors to windward recently. And someone was reminding me of this. I know that my predecessor on these calls would talk about hedge funds, and I think sometimes apparently he had received some criticism about hedge funds when the market is racing upward, like it really had been a lot since 2009, a big beta-driven rally. Hedge funds tend to lag. And so one might say, well, how come we're invested in these things? They're not doing as well as they should, et cetera, et cetera. And I think his response was, we own the hedge funds for when the markets are not doing well. And that's exactly correct. The hedge fund part of our portfolio, which is a little bit more than $100 million, has actually made money this year. Not much. It's made a couple of percent this year. And that has been the answer to other things going down. And the reason why we are able to outperform our benchmark as well as our peers is to have that kind of anchor that is actually generating a small amount of return in a year when everything is going down. The other important thing about this year in particular is that, remember, I talked about how the Bloomberg Ag, the bond index, has really gotten crushed this year. It's historic levels of negative return for the Ag. And the investment committee before my tenure had made a decision to keep the fixed income exposure relatively light than it had been by comparison. So our total bond exposure is in the neighborhood of around 5%, and that's actually proven to be a very prescient tactical move, coming into 2023. That's really helped. So that 5% has gone down, just as all the bonds have, but we had so little of it that its impact was relatively muted. The other thing that I want to remind everyone of, or to emphasize, is that we have a very seasoned investment committee. The combined years, I guess this, and maybe this will, hopefully the investment committee would not see this as an insult since it does get at their age, but when you put the whole investment committee together, it's more than 150 years of collective experience. This committee has been through multiple market cycles, up and down. It's very seasoned, very expert, and incredibly helpful. And we are always looking to optimize return and risk. By that, I mean that we're always thinking of, are there better ways to be doing what it is that we're doing? Are there different managers that we should be doing? Should we upgrade this piece of the portfolio? Is there something new that we haven't thought about that we should be thinking about? So that's my job, and that's what I'm constantly spending my time doing in consultation with the investment committee and with our investment consultant. So that's the character, if you will, of our all-weather built to last, built to run portfolio. And I just want to stress this last part. This is at the risk of repeating myself. You know, I used to be a professor, so the old saw when you're a professor is you say what you're going to do at the beginning and then you repeat it all at the end. Well, we are and we will remain a vigilant long-term investor, and we are focused on safeguarding and growing the assets that you've entrusted to us. That's at the core of everything that we're thinking and deciding and doing here. And I hope that is useful and of some comfort while we are in the midst of a pretty challenging environment. So that's all I have. Those are my my formal remarks. Thank you. Always available for feedback. You can contact me directly. You can contact Leanna. Always happy to talk, answer questions, and anything else you'd like to talk about. And happy to take questions now. I know that there's an option to do that. So I'll stop there.
And we did have one question.
Great.
What sort of screening does the investment committee consider when making decisions? I'm thinking in terms of environmental, social, and governance concerns.
Yeah, thank you. Very good question. We recently this year in May, we passed a statement of responsible investing. And one of the principles of that is it says that we are interested in partnering with investment managers that have an ESG policy and then have a demonstrated commitment to diversity, equity, and inclusion. So we haven't added any new managers to the portfolio since I've been here, but an important part of that screen will be, does the investment manager have such a policy and such a commitment, and in fact, are they taking it seriously? So that's that. There are the other due diligence screens. We always want to understand what sorts of business risk investment managers have, what is their process, their philosophy, et cetera, et cetera. But from that point of view about sustainability, that's the level of screening that exists right now.
I can just add to that we do have a copy of that statement of responsible investing on our website under the investing our assets section, and we could always forward that individually as well. But that is all for the questions at this point, Brendan.
Great, thank you. Again, just want to emphasize, I'm always happy to chat. Please do reach out on email, call me, come by the office. Always happy to talk about our investment program. You're more than welcome, of course, to email Leanna as well. And
sorry, we got one more.
Oh, good.
One just came in, Brendan. What is your thinking on the size of your European investment portfolio, given the impact of the invasion of Ukraine?
Yeah, so excuse me, two things about that. So we have minimal exposure. Very quickly, we have minimal exposure to Russia, just from that side, from that point of view about our emerging markets exposure and our Russia exposure. Very, very minimal exposure there, non-existent now since that market is no longer liquid. And so that had a very minimal impact on the portfolio. We have very good managers in Europe. We are not adding to our allocation in Europe, but we're not downsizing that allocation either. We're happy to stand pat at the moment and see. I think Europe is ahead of us in recessionary terms. And also, as we've seen what happened with the UK earlier this fall. So we're happy to stand pat there. We're not downsizing, nor are we increasing our position.
One more. Let's see. Do you or your ESG managers have fossil fuel screens or might be considering those options in the future?
No, that's a blunt, a big answer. Let me nuance that a little bit. We do not have fossil fuels screens, explicit fossil fuel screens in place. I can say that when we have had the opportunity to explicitly add fossil fuels to the portfolio, we've demurred on that. We do have some managers that do have fossil fuel exposure in the portfolio. I'm thinking of at least of several hedge funds. And so having an ESG policy does not mean no fossil fuels, just to be really clear about that. You can have fossil fuel producing companies that have very high ESG scores because they do very well in other sorts of things, even though they're, say, extracting oil from the seafloor. So we do not at our portfolio level have an explicit fossil fuel screen, nor do our managers have one. If you are interested in a fossil fuel free portfolio, no fossil fuels at all, we do have an option there. We work with Boston Walden Trust, and that portfolio is a fossil fuel free. It explicitly screens out all fossil fuels. So that is an option, but our portfolio does not, and I don't see nothing in the foreseeable future. I don't see us instituting a screen like that.
All right, Brendan, and then a couple other questions that have come in somewhat related to what you were talking about. Do you instruct a manager how to vote proxies, or what guidance do they follow, such as ISS, MSCI, or Glass Lewis?
We do not instruct our managers on voting proxies. That is something that I would like us to investigate and explore further in the future to see about possibly changing that. And I couldn't tell you exactly. The different managers follow different guidelines on how it is that they go about doing it. So the short answer is we do not, and I think our managers are using a variety of different methods to get there.
Okay, great, thank you. And also there was a question about the performance returns that were in the materials, asking if those were net of fees.
Yes, they are. These returns are all net. They are not net of the administration fee that MaineCF charges, but they are net of all trading, investment manager, et cetera, fees.
Okay, and there's been some follow-up questions on that. The admin fee, as Brendan said, is based on fund type. So a donor advised fund would have a different administrative fee than something like a designated or an agency fund.
Right.
And so all of the administrative fee would come out after the net performance. The net returns are allocated, I should say. We had a related question on what is your percentage management fee?
The percent of, do you mean the fee that MaineCF charges to our fund holders?
I would say more on the investment managers, like roughly what percentage is the
blended investment manager fee? It's about 1.25%. I can get actually I can get a real detailed number there if we can take down that person's information. I believe it's about 1.25% blended all in, because we have so private equity and venture capital vehicles and hedge funds tend to have higher fees, and they tend to be variable because they'll have a performance fee that is attached there. So depending on how they do, they make more or less. And then we have other vehicles where the fee is fixed and usually lower, say global listed equity or a bond fund, for example. It's going to have usually just a fixed, much lower fee. But I think when you blend it all out, it's around $1.25, about 1.25%.
Super. And so going back to the statement of responsible investing, I think you might have highlighted this, Brendan, but if you want to go back to that to say what proportion of the investments are with ESG managers, and related to that, do you find that the ESG managed funds do as well as the non-ESG?
Well, yeah, we only have 2 managers that do not have an ESG policy. So I want to be clear, our managers are not, they're not running separate ESG products per se. Like you can go buy ESG versions of a strategy as opposed to sort of a, a plain or not normal, a plain or a mainline sort of down the middle of the fairway kind of strategy. We do not specifically say we want to have the ESG flavor, but we do want to be with managers that have some kind of a statement about ESG or sustainability, because what you find is that many, if not most managers, actually were already practicing some level of ESG awareness in their stock picking, in their investing. So for example, an important part of ESG is governance. What kinds of governance practices does a certain company have? Pick a company, Apple or Facebook, whatever company you're thinking of. What sorts of governance procedures, processes, policies do they have? Are they shareholder friendly or not? Are there, do they have insiders on their board or not? Things like that. Those are all pretty long-standing criteria for bottom-up stock picking managers to be thinking about already. So my point is just that many of the managers would already be thinking of these risk factors independent of whether or not they had an explicit policy in place. So a long-winded way of saying we don't have specific ESG funds. We do have the vast majority of our managers do have ESG policies in place where they've come out and said, we believe in these things and these are the things that we do. And we only have 2 managers that do not have a written ESG policy, although candidly, I think both of them are considering different ESG risk factors in their analysis, but they don't actually have policies. So I know that's long-winded and a little complicated, but I hope it gets at the question.
And Brendan, I think the last question we have, and it was asked earlier, but I sort of held it to the end. So I think it's a nice way to end things. And I would suggest that folks tune in to the February webinar for more on this. But the question was, do you look to investing in Maine specifically?
Boy, that's such a terrific question after my own heart. Thank you for asking it. Right now, we do not have any explicit policy or program for investing in Maine-based companies or even Maine-based investment managers. A goal going forward is to develop something more robust in that direction, to figure out how, as part of our strategic plan, as part of the way we're thinking about things. It's something that I spent a lot of time thinking about. How can we utilize the portfolio, the heft of the portfolio, to have a greater impact in our home state? We have impact in many ways. We're hopefully, this year, obviously a challenging year, but hopefully assets are growing and those assets are then being philanthropically distributed in all kinds of good ways in our state. And then the next question would be, are there ways for the portfolio to be, from an investment point of view, not from a philanthropic point of view, having a greater impact in our state? And I can stay tuned. I wish I could speak more specifically, but I will in the future be able to speak more specifically about that. And I love the question. Thank you.
That looks like it should do it for the questions. Thanks, Brendan.
Of course, please don't hesitate to reach out anytime I can be helpful. I am going to, excuse me, I just want to turn it over and introduce our new CEO, Deborah Eltwood. I hope some of you have had an opportunity to meet Deborah. If you haven't, you're about to right now. And I think you'll find it to be a wonderful and invigorating experience. So with that, Deborah, I'll turn the floor over to you. Thank you.
Thank you, Brendan. And I really want to thank you and the investment committee for the really careful oversight of the Maine Community Foundation portfolio. As Brendan said, these are very experienced committee members, and we're very fortunate to have them to guide us through these challenging times in the market. And, because of our confidence in the investment committee's stewardship, and because the organization has taken a number of steps over the past dozen years or so to build a healthy operating reserve, Maine Community Foundation is really in a good position to weather the market downturn and to move forward with our recently adopted strategic plan. So next year, we are going to be focused on the continuing improvement in operations, and this is going to be including upgrades to our technology. You're going to see refreshed communications, among other things. We're going to be gaining an understanding of how we can continue to best serve our fund holders, whether it's through informational sessions like these regarding our investments, or peer learning opportunities, or content expertise for individual donors as you are to support your grant making. And then we're going to have a greater focus on our own impact, which next year will include a very thorough and methodological assessment of where Maine Community Foundation and how Maine Community Foundation can be helpful in addressing some of the most pressing issues that are now facing Maine. And so as part of this, we'll be collecting information from our individual donors on what issues might be important to them. We'll also be checking in with not-for-profits and content experts and other funders and other community leaders as part of this process to really understand where Maine Community Foundation might be able to make a difference as an institution. So I am really optimistic about the future of this organization. In addition to this solid financial picture, we have a very strong and engaged board that is enthusiastic about the next phase of Maine Community Foundation. And I came with fairly significant experience and knowledge of community foundations. I was on the vice president and a board member of a community foundation in upstate New York. And then in my last role, I worked with sort of hundreds of community foundations across the country, really helping them to increase their effectiveness. And I'm really thrilled to be at Maine Community Foundation to really build on the great work that's been done for the past 4 decades or so. So at Maine Community Foundation, we bring people and resources together to build a better Maine. And we're really honored to work with all of our fund holders to help us accomplish that really important mission. So I want to thank you for your participation today, but also for entrusting us with your philanthropic resources. So we look forward to a continuing productive relationship with all of you. So with that, I'll turn it back to you, Liana.
Thank you, Deborah. Thank you, Brendan. I don't see any other questions in the queue, but again, please feel free to reach out to either Brendan and me if you do think of something later, or if you are having a chance to listen to the recording of this call. We are always available. We appreciate the partnership that we have with all of our fund holders. If you're listening live, get out and enjoy the beautiful afternoon, and we will look forward to checking in with folks in February, if not sooner. Take care.